42 years old, $230,000 in a 401k, no debt except the mortgage, no crypto disasters, no reckless decisions of any kind. His financial advisor looked him in the eye and said he was on track. And he was on track to retire at 68, not free at 55, not living off his portfolio in his early 50s, grinding until 68, same as his father did, same as his father's father did, on a treadmill that looked like a career path from the outside. Here's what nobody told him, and what I'm going to show you with actual numbers before this video is 15 minutes old at 42. He already had everything he needed to retire 14 years earlier. The income was there. The compounding runway was there. The tax advantage levers were sitting in the tax code waiting to be pulled. What wasn't there was a framework for seeing any of it. And that's what this video is. Your 40s are not a checkpoint. They're the most financially powerful decade of your entire working life. And most people treat them like a continuation of their 30s, which is the most expensive mistake in personal finance. Here's what I'm going to do. I'm going to walk you through the specific mechanics of why this decade functions completely differently from every decade before it, mathematically, psychologically, and structurally. I'm going to show you the exact dollar cost of delay that makes your 40s unlike any other 10-year window. And I'm going to walk you through the 4 specific levers that determine whether you exit this decade with escape velocity or spend the rest of your working life in financial orbit, always circling, never landing. By the way, I built a free early retirement calculator because most of the ones you find online are mathematically wrong. They omit inflation adjustment, understate fee drag, and don't stress test for sequence of returns risk, which is the scenario where markets drop hard in your first 2 years of retirement and you're forced to sell depreciated assets for income, permanently damaging your portfolio's long-term survival. Mine uses the actual methodology that Vanguard and BlackRock apply when they model retirement outcomes internally. It'll show you the specific weak points in your plan. I only ask for your email to send the report because I don't store your financial data. Link is in the description. Now, picture a rocket launch, not the Instagram version with the fireball and the crowd and the inspirational music overlay, the technical version. When NASA plans a mission to Mars, the trajectory window, the precise slice of time when Earth and Mars are aligned, optimally opens for a few weeks, once every 26 months. During that window, the orbital mechanics work entirely in your favor. Minimum fuel consumption, maximum velocity efficiency, correct arrival geometry. Everything that's hard in other circumstances becomes almost cooperative. Miss the window and you can still get to Mars. But you're burning 3 times the fuel, taking far longer to arrive, and showing up with diminished capacity relative to what you'd originally planned. The window isn't arbitrary. It isn't a preference. It is a product of physical laws operating on a fixed schedule, indifferent to your readiness. Your 40s are that launch window, and the orbital mechanics of your 40s, the specific convergence of higher income, compounding momentum, reduced early career obligations, and a portfolio that's finally large enough to generate real growth on its own, are exactly as real as planetary geometry. Miss the window, and retirement doesn't become impossible. You burn everything you have trying to get there. You arrive late, you arrive depleted. And unlike NASA's situation, there's no next window 26 months later. This is the window. The question the entire video comes down to is whether you light the engines or whether you coast, and wonder why the destination keeps receding. I'm going to come back to this rocket throughout the video. The metaphor holds in ways that are genuinely uncomfortable if you're in your 40s right now, and treating this decade like more of the same. In a few minutes, I'm going to show you the exact dollar number that separates someone who retires at 55 from someone who works until 68, and it's almost certainly not the number you're expecting. But first, here's why lifestyle inflation is even more broken than the version of this lesson you've already heard. Because the standard advice doesn't go deep enough to actually change anything. The standard lesson goes, you get a raise, you spend more, that's bad, don't do that. You've heard it. You probably nodded. You probably upgraded the car the next time a raise came in anyway, because the advice was aimed at your wallet, and your wallet doesn't make decisions. Your brain makes decisions. And your brain has been running a firmware update for this exact situation since before you were born. Here's the actual mechanism. Every lifestyle upgrade isn't a purchase. It's what I'd call commitment architecture. A load-bearing structure of recurring fixed obligations, the bigger mortgage, the car lease, the private school tuition, the neighborhood-appropriate vacation budget, the club membership that gradually shifted from optional to socially mandatory, that your income now has to support continuously, indefinitely, or everything collapses in sequence. Pull the income for 90 days and count the structural failures. The mortgage starts, the school fees start, the lease payment starts. None of these things pause while you figure out the income problem. The lifestyle you built on top of your earnings now requires those earnings to continue existing. There is a psychological term for the engine underneath this: hedonic adaptation. The experimental foundation goes back to Brickman and Campbell's work in 1971, though the behavioral economics community built the modern framework out considerably through the 90s. The mechanism is this: your brain normalizes improved circumstances with remarkable speed. Give it a nicer house, a better car, an upgraded life, and within roughly 8 to 12 weeks, the upgrade stops registering as a bonus. It becomes baseline. It stops producing the emotional return you expected when you made the decision. So you need the next thing, not because you're greedy or irresponsible or bad with money, because your brain is running an evolutionary adaptation that was genuinely useful in a different environment and is actively working against you in this one. And here's the uncomfortable part about who this actually catches. Not the reckless spenders, the disciplined, high-earning, responsible professionals. Because every upgrade was earned. Every upgrade was affordable. There was no red flag, no crisis moment, no intervention. There was a kitchen renovation and a gradually tightening feeling in the chest when thinking about what happens if the income stops. The Pew Research Center has documented this pattern. A significant portion of American households earning between $100,000 and $200,000 annually report persistent financial stress. Not poverty stress, not crisis stress. The specific stress of someone who has constructed a life that is entirely dependent on their income continuing, and at some level knows it. Earning six figures, feeling financially fragile, that is not a math problem. That is commitment architecture built on top of an income stream instead of an asset base. There's a story I keep coming back to when this conversation comes up. A fisherman on a small coastline, entirely content, works when he wants, earns enough, spends his afternoons however he pleases. A businessman passes through, observes the operation, immediately sees the underutilized potential. He lays out the full roadmap: secure investors, scale the fleet, expand to adjacent markets, build toward an acquisition or an IPO, exit with real wealth. The fisherman listens carefully and asks how long all of that takes. 20 years minimum, says the businessman. And then what? Then you can retire. You fish whenever you want, sit on the beach, live however you like. The fisherman looks at him without any particular emotion. That's what I'm doing now. The lesson most people take from that story is be content with less. That is not the lesson I want you to take. The lesson is about commitment architecture. The fisherman never built a structure that required him to keep performing to maintain his own life. The businessman's plan required 20 years of accumulating obligations before it delivered the thing he was supposedly building toward. And Trevor, who you'll hear more about, walks straight into that 20-year structure, not out of recklessness, but out of something far more seductive: the feeling of progress. Because every commitment felt like an achievement. Because every upgrade looked like evidence that it was working. Trevor's financial advisor, by the way, was extremely supportive of the lifestyle expansion. A bigger house meant more equity eventually coming under management. A stronger income profile meant more capital to deploy over time. When Trevor asked if he was on track, the advisor said yes, and meant it precisely in the sense that Trevor was on track to retire at 68, while the advisor was on track to collect another 12 years of management fees on Trevor's growing asset base. Everyone on track to their own destination. Now you're asking yourself, what does someone ask instead? What is the one reframe that actually changes behavior? Victor stopped asking how much he makes. He started asking how much his money makes while he sleeps. Those sound similar. They are completely different questions. The first is about you as a laborer. The second is about whether you have built an army. Every dollar Victor deployed into a productive asset, a low-cost index fund, a dividend-paying equity, a cash-flowing rental property, is a soldier working on his behalf 24 hours a day, without compensation demands, without sick leave, without needing motivation. The goal isn't more soldiers. It's smarter deployment of the ones already in the field. And the launch window of your 40s is when that army, if you've been feeding it, starts to have enough size to generate real compounding momentum on its own. This is where it gets really interesting, because the math of this decade is not linear. Compounding doesn't grow in a straight line. It grows on a curve that bends sharper the longer it runs. And your 40s are the decade when, for a lot of people, the curve starts bending seriously. Here's the specific number that clarifies why this decade is different from every other one. $500 a month invested in a low-cost index fund with an 8% average annual return starting at 40 years old and running to 65. That's 25 years. Final value, approximately $475,000. Take that identical investment, same $500, same fund, same 8% return, and start it 5 years later at 45 instead. Final value, roughly $295,000. $180,000 evaporated. Not from a bad investment decision, not from a market crash, not from any visible mistake, from 5 years of delay. The only variable is the start date. The clock costs more than most bear markets. Now, apply that to a real contribution rate. A 40-year-old maxing their 401k at $23,500 annually at 8% average return, running to 65, accumulates approximately $1.9 million from that single account alone. Start 5 years later at 45, approximately $1.2 million. The 5-year delay costs $700,000 from one account, not from bad allocations, not from market timing failures, from inertia, from the bank calculator that told Trevor everything was fine, from the launch window partially closing without anyone noticing. That is gravity working in real time. The bank's retirement calculator, built by the same institution that earns fees on Trevor's deposits, his mortgage, his overdraft protection, and eventually his investment products, calculated that Trevor would retire comfortably at 67. 67, like a particularly fine wine that just needs another 23 more years to fully develop. The calculator wasn't lying. It was modeling 67 because 67 is what the math produces when you plug in Trevor's savings rate, his contribution level, and his lifestyle costs. It never asked Trevor if 67 was what he actually wanted. It never asked whether the assumptions baked into its model matched Trevor's actual life. It just generated a number and called it a plan. Stay with me, because this next part is where the actual leverage lives. Here's a pattern interrupt that breaks most people's mental model of this problem. The difference between someone who retires at 55 and someone who works until 68 is almost never income. I know that sounds wrong. The data proves it. According to DQIDJ's analysis, a Federal Reserve survey of consumer finance data, the median net worth of Americans aged 45 to 54 sits at approximately $212,000. Median, right in the center of the highest earning decade of most people's careers. After potentially 25 years of adult financial life, a median person in their early 50s has $212,000 in total net worth. At the 4% rule, that sustains annual income of about $8,500. Not retirement, not close to retirement. A number that requires either a dramatic savings acceleration or a grinding continuation of full-time work for another decade and a half. The average net worth for the same cohort is around $800,000, massively skewed upward by a small number of extremely high wealth households. Strip those out, and you're looking at a population that, in aggregate, has not built the kind of asset base capable of producing financial independence. And the majority of those people don't know it because their income is high enough that they feel like they're doing well, and the systems around them keep confirming it. Let me give you a case study that's close enough to feel real, with exact numbers you can map your own situation against. Call him Daniel, 42 years old, software project manager, base salary of $120,000, performance bonus eligible, $230,000 in a 401k parked in a target date 2045 fund, expense ratio of 0.15%, reasonably efficient on the fee side. Mortgage with 19 years remaining, 1 car payment, 2 kids aged 11 and 14, uses the retirement calculator on his brokerage's website. It tells him he's on track. He believes it, because why wouldn't he? Here's what the calculator didn't model. It assumed he'd need 70% of his current income in retirement. Daniel doesn't want 70%. He wants to travel. He wants to see his grandchildren. He does not want to spend his retirement years counting expenses like he's still 40 and anxious. His actual desired annual spending in retirement is $90,000. Not extravagant, not a luxury number, the real number. At the 4% rule, his FI number is $2.25 million. The calculator was solving for a different target. Daniel had no idea there was a gap between what he actually wanted and what the model was optimizing for. Now the real math, $230,000 at age 42, growing at 8% for 23 years until age 65, becomes approximately $1.06 million without another penny added. But Daniel can add more. If he maxes his 401k at $23,500 annually from now until 65, those contributions compound to approximately $1.8 million over that period. Combined with the existing balance, roughly $2.86 million. He clears his FI number. He makes it to the destination. But here is the quiet problem. For the past 3 years, Daniel has been contributing roughly $11,000 annually instead of the $23,500 maximum, because his financial advisor suggested splitting contributions between the 401k and a brokerage account with a higher fee product structure. That 3-year gap in contributions at 8% compounding over 23 years cost Daniel approximately $140,000 in final portfolio value, not from a market crash, not from a bad pick, from a contribution rate that was lower than optimal for 36 months because nobody showed Daniel the specific number attached to that decision. Every year, Daniel doesn't fully max the 401k costs him roughly $45,000 in final portfolio value because of where he sits on the compounding curve. That is the launch window math made concrete. That is the cost of not knowing what you're actually deciding. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may genuinely never surface this channel to you again. The algorithm doesn't know this video exists unless subscribers signal that it's worth showing people. I can't fix that side of it. What I can fix is making sure the next video justifies the click. Now, the 4 levers. The operational mechanics of actually hitting escape velocity instead of watching the window close. Lever 1 is allocation velocity. This is not about stock picking. It's about knowing your FI number, calculating your current trajectory at your current allocation, and having an explicit opinion about whether your portfolio is growing fast enough to close the gap by your target date. Most people who look carefully at this in their 40s discover they're parked in something too conservative for their actual timeline. A target date fund built for someone retiring in 2045, held by a 42-year-old today, will spend the next decade and a half progressively de-risking, reducing equity exposure, increasing bond weight, slowing the growth rate. That's the fund doing exactly what it was designed to do. What it's designed to do might not match what you need to hit your specific FI number by your specific target date. The fund doesn't know your FI number. Only you know your FI number. Knowing it and comparing it to your trajectory is not optional analysis. It's the foundation of every other decision. Lever 2 is the catch-up contribution. This is the most consistently under-leveraged provision in the entire American tax code, and I say that with genuine frustration because it is sitting in plain view and most people have never been told about it. If you are 50 or older in 2026, you can contribute an additional $7,500 per year into your 401k on top of the standard limit of $23,500. Total available $31,000 annually pre-tax. If you happen to be between the ages of 60 and 63, the Secure 2.0 Act signed into law in 2022 increased the catch-up provision further to $11,250, putting the total at $34,750 per year. $7,500 annually, invested at 8% for 15 years. Compounds to approximately $210,000 in pre-tax dollars. That is a second retirement account hiding inside the first one, written into the tax code specifically for people in your exact situation. Not mentioned by most advisors, not featured on most calculators. Just sitting there, waiting. Lever 3 is the fee audit. I'm going to make this universal because it applies to almost everybody. If you have $200,000 invested and you're paying an average expense ratio of 1%, which is close to the industry average for actively managed mutual funds, according to Morningstar's annual fee study versus shifting to Vanguard's total stock market index fund at 0.04%, the annual fee difference on that $200,000 is roughly $1,992. That gap, invested at 8% for 20 years, is approximately $98,000 in lost portfolio growth. On a $200,000 base, most people have more than $200,000 by their mid-40s. Scale the math accordingly. This is not a marginal optimization. This is a structural cost that is quietly extracting material portions of your retirement capital every single quarter through a mechanism that never appears as a line item on any statement you ever receive. Lever 4 is income, redundancy, not multiple income streams. In the social media entrepreneur sense, that phrase has been so thoroughly colonized by people selling courses that it's almost meaningless now. What I mean is specific and narrower. By your mid-40s, your primary income should not be the only structural support for your financial life. One layoff, one health disruption, one company restructuring that eliminates your role, one period of burnout that requires you to step back before you're financially positioned to do so, and a career that took 20 years to build can become a financial crisis inside of 6 months. The people I've watched absorb those disruptions without long-term damage almost uniformly had a second income stream before they needed it, not a business requiring 40 hours a month to maintain. A taxable dividend account generating $3,000 to $5,000 annually. A rental property with $400 of monthly positive cash flow. A bond ladder that produces predictable interest. Something that generates cash without requiring your physical presence, not replacing your salary. Extending your runway long enough to solve the problem rationally instead of desperately. Now Marcus's story comes back, because what he actually did is the point. After someone in his professional network showed him the fee math, the $280,000 compounding gap from the 1.2% advisor fee over 20 years, Marcus spent about 2 weeks furious. Standard response. Then he spent 90 days being forensic about it. He pulled every fund prospectus. He looked at every expense ratio. He ran a historical performance comparison between his actual portfolio and a simple 3-fund index approach. Total US market, total international market, bond index through Morningstar's data over the prior 15 years. The gap in net annualized return after fees and trading costs was approximately 1.3% per year in favor of the simple index approach. Not in one exceptional year, consistently across the full 15-year period. He restructured methodically. 90% of assets moved to self-directed index funds. His advisor retained on a flat $500 annual retainer for 2 specific annual consultations, tax loss harvesting, review, and estate planning checkpoint. Annual investment costs dropped from approximately $5,000 to under $400. The compounding value of that fee reduction over 20 years at 8%, over $350,000. Marcus didn't become an expert. He became informed enough to make one structural decision, then he put it on autopilot and went back to living his life. Nobody will give Marcus an award for that. It will never come up at a dinner party because there's nothing to say, I switched to index funds and renegotiated my advisor fee. Is not a story anybody wants to hear. But in roughly 17 years, when Marcus retires at 61, with somewhere between $350,000 and $400,000 more than his original trajectory would have produced, and the Tuesday afternoon he moved, those assets will have been the single best financial decision of his adult life. Let me close by returning to where this started. Victor and Trevor. Same age, same neighborhood, same starting conditions at 40. Victor is free at 55. Trevor is still calculating grocery totals at 55, still checking the account before committing to the vacation, still telling himself the next few years will be the ones where he finally gets ahead. What is the actual system failure in Trevor's story? Because Trevor is not a cautionary tale about laziness or irresponsibility. He worked hard. He paid his bills. He loved his family. He did everything you're supposed to do. The failure is that every single financial institution Trevor interacted with had an incentive structure that pointed away from Trevor's independence and toward his continued engagement as a customer. The bank calculator optimized for Trevor staying a customer. The advisor's fee structure rewarded a longer, larger, continuing relationship. The mortgage refinance was framed as equity optimization instead of what it actually was, deepening the commitment architecture. The lifestyle inflation looked like success from the outside and felt like progress from the inside. Trevor wasn't defeated by a conspiracy. He was navigated by incentives he never examined in a direction that served other people's interests more than his own. And nobody ever handed him the framework to see it. Victor understood this not with paranoia, with that particular amused disappointment you develop when you finally read the fine print on a game you've been playing for years and realize some of the rules are written to favor the house. Low-cost index funds, because the SPIVA report published by S&P Global shows that over any 15-year rolling period, roughly 88% of large-cap active fund managers underperform the S&P 500 net of fees. 88%. Tax advantage accounts maxed because the math on pre-tax compounding is as close to free money as the tax code gets. FI number known precisely because specific targets produce specific behaviors in a way that vague aspirations never do. Commitment architecture audited annually to make sure the income is not load-bearing. 3 things you can do this week, not eventually, this week. 1, calculate your FI number tonight. Take your actual desired annual spending in retirement, the real number, the one with travel and healthcare and the life you actually want, not the 70% of current income fiction someone typed into a model and divide it by 0.04. Write it on something physical. Tape it somewhere visible. That number changes every financial decision you make going forward because it denominates every dollar you spend in terms of how many more months you need to work to replace it. It's not a guilt mechanism. It's a GPS coordinate. 2, run a fee audit on every account you have. Log in, find the expense ratio on every fund, and compare it to the Vanguard or Fidelity equivalent. Calculate the difference in fees annually, multiply by your balance, compound that difference at 8% over 20 years. Whatever number comes out of that calculation is the fee audit dividend. What you get to keep by making one allocation change that takes about 45 minutes. 3, if you're not maxing your tax advantage contributions right now, build an explicit 12-month plan to get there. Not someday, 12 months. If you're over 50, the catch-up provision is $7,500 additional pre-tax dollars a year sitting in the tax code waiting for you. That's money the government would otherwise take, redirected into compounding assets instead. The launch window is still open, but it has a real close date, and the fuel you don't burn now doesn't transfer to the next window. There is no next window. Lazy investing built more fortune than crypto memes. And the data is overwhelming enough that this isn't a matter of opinion anymore. 88% of active managers underperform a cheap index fund over 15 years. Fee drag costs the average investor 6 figures over a career. Catch-up contributions go unused by the majority of eligible participants. The boring, patient, systematic approach isn't the safe choice because it's cautious. It's the right choice because the math is not close, the evidence is not ambiguous, and the people who got rich quietly on low-cost compounding are not the ones writing books about it. The gravity is always working. The question was always whether you hit escape velocity before the window closed. For a lot of people listening to this right now, the window is still open. The math still works. The compounding is still waiting. Light the engines.